Tom Lee's fund strat said today, quote, 2 weeks ago, we noted that equities were about to face a fragility test, given the dual risks of fears of inflation resurgence plus the Middle East conflict. But ultimately, we expected stocks to survive this test. As we exit April, the rally of the past week has bolstered our confidence that the worst of the selling is done, and thus we believe probabilities favor stocks to stage further gains. So Tom Lee over at Fundstrat, really the entire Fundstrat team, they're pretty bullish on markets right now. Well, the bull is bullish. I don't think that's huge new information. But what am I? Am I bullish? Am I bearish? I think I offer a perspective that is neither perma-bull nor perma-bear. I see things for how they are, and I will share with you the latest information that you need to know, including what caused this drop today towards the end of the day in the NASDAQ. This was a pretty aggressive sell-off, and it started to really make a lot of people question, like, what's going on here? As I mentioned in multiple videos over this weekend, there are three main themes for stocks this week. You have earnings, number one. Number two, you have the Fed. And number three, you have economic data. Whatever happens with these three main themes will dictate what happens next for markets. And what we've seen today, you didn't really have much for earnings. You didn't have any economic data, so there's nothing new on that front. The Fed didn't necessarily give us new information, but I will point out that the Russell outperformed the NASDAQ by about 2x today. So the Russell was up 0.7%. The NASDAQ was up 0.35%. So exactly doubled what the NASDAQ did. It was a very good day for small cap stocks today. This is the markets front running the Fed. Now we'll see if that happens tomorrow and in the beginning parts of Wednesday as well. But right now, this would say that investors under the surface where the capital is moving into small cap stocks heading into the Fed. And I actually think that's a pretty good bet. As I've said before over the last couple of days, I'm pretty dang bullish on the Fed this week. And it comes down to simple what the markets are pricing in. Okay. The markets are pricing in one cut by the Fed this year. Now, the Fed has reasons to cut rates now, or at least a reason to cut rates. The quarter-over-quarter GDP numbers last week came in about 1% lower than expected. So the economy's not running as hot as we previously thought it was. So now the Fed has at least one thing they can point to and say, hey, maybe we should start reducing some of the strain on the economy and reduce financial conditions at least a little bit. Now, the only way that I see the Fed as being this huge negative catalyst is if we rally big into the Fed, then maybe it'll be a sell the news situation. But the Fed itself, I think it's going to be pretty dang bullish for markets because you're only pricing in one cut. The dot plot that we just recently got was pricing in 3 cuts, but really only pricing in like 2. If you net, the average Fed official was pricing in about 2 cuts. The only way things are bad with the Fed from that standpoint is if the Fed, Jerome Powell, says, hey, we may not need to cut rates at all in 2024, then that's a problem. If the Fed says we may need to raise rates raise rates in 2024, that's an even bigger problem. I don't think either one of those is going to be communicated to the markets. I think that's a pretty low chance. I think the Fed's still going to say, we plan on cutting rates this year. And markets are priced for that. Markets are priced for one cut. If it sounds like the Fed might do more than one cut, stocks could have a lot more upside following Wednesday. Now, the other aspect to the Fed meeting is the pace of the balance sheet reduction. So the Fed is running off $60 billion a month in treasuries and $30 billion a month in mortgage-backed securities. And they've had a lot of progress reducing the size of their balance sheet. You're starting to see excess deposits running out in the banking system. There's not as much money as there was before for banks to go out and buy all of this excess treasury issuance, right? All of these treasuries out on the markets. So the Fed's being quite literally forced to slow down this reduction of their balance sheet. And that's going to be very accommodative to the bond market. Now, we did get some bad news today that sent yield a little higher at one point and sent markets lower. And that was actually news from the Treasury. So the Treasury announced today that during the April to June 2024 quarter, so the current quarter, the Treasury expects to borrow $243 billion in privately held net marketable debt, assuming an end of June cash balance of $750 billion. The borrowing estimate is $41 billion higher than announced in January of 2024, largely due to lower cash receipts, partially offset by a higher beginning of quarter cash balance. During the July through September 2024 quarter, the Treasury expects to borrow $847 billion in debt, assuming an end of September cash balance of $850 billion. These were both higher than expected, and well, that sent the markets down sharply, because imagine it like this. The Fed is rolling off $90 billion a month in treasuries. The Treasury's selling, about the same, maybe a little bit more in bonds every single month on average. That's a lot of selling pressure in the bond market. This is the chart of TLT. There's been a lot of selling pressure on TLT. When TLT falls, this is the ETF for the 20-year Treasury. It works for the 10 and 30-year Treasury as well. When this goes down, yields go higher. So markets said, hey, prices of bonds are probably going lower as there's more selling of bonds. Thus, yields are probably going to go higher, and that's bad for stocks. Now, we'll see if the Fed does not start to slow the pace of their balance sheet reduction, then I think this will be even worse news. But so far, I think the market's mainly shrugged it off. Now, in terms of our markets, tomorrow is going to be an absolutely huge day. Pre-market, you will have PayPal, Eli Lilly, 3M, McDonald's, Coca-Cola, SiriusXM, Oatly, and a couple other names reporting earnings. These specific sectors could be important, like PayPal will affect your financial services sector, right? Maybe credit card companies. 3M, Eli Lilly can affect healthcare. McDonald's will affect food names. Same is true with Coca-Cola. So a couple different sectors reporting earnings here that could be important. But mainly it's Amazon, AMD, and Supermicro that report earnings tomorrow night, or in after hours tomorrow, that will be the biggest wild card for this week in terms of everything. Like, I think the Fed, I think the economic data likely is a little bit easier to see or read through than these earnings. Meaning, I'm pretty confident the Fed is going to be dovish. I'm pretty confident the data is going to come in mainly in line with estimates. We're not going to get a huge shocker. I don't have any clue what AMD or Supermicro are going to say and how that could affect the AI trade. I have opinions, but I have nothing, statistically relevant that I can share with you that'll say Supermicro is going to beat, AMD is going to beat. They're going to have great things to say about their business and give great guidance. And when so much of this rally we've seen in 2024 has really been focused around AI, if that AI enthusiasm dies down, that would be a problem. Now, I think for the most part, a lot of that, some of that, a good percentage of the AI hopium has kind of died down on the surface. It's not just your semiconductor stocks that are, doing well or whatnot. But I think there's still a lot of AI hype that is embedded in a Microsoft, in a Meta, even still, just judging off of where those stocks in particular are at. But obviously, NVIDIA, SMCI, AMD, the whole shebang, like most of your big tech names out there on the markets today have benefited in a huge way from AI. And just depending how those earnings go tomorrow, that will really dictate which way I believe the markets will go for this week. If things are really bad at AMD and Supermicro, the lows are probably not in for this latest correction, if you will. If those earnings are good, you're probably not going back to the lows, because I think the Fed's going to be very bullish. And I think the data is probably going to come in line with estimates. We do have ISM service data that comes out before the Fed on Wednesday. And we have JOLTS job openings as well that come out on Wednesday. Not expecting much of a change there. And then there's really nothing on Thursday. And then you have non-farm payrolls and the unemployment rate on Friday. But one of the obviously big stories of this week is the Fed. And I think the Fed would have to come out and be very hawkish for the markets to take the Fed as negative, because just what we're pricing in, only one cut from the Fed, that's pretty negative compared to, where we were even a month ago, pricing in a solid 3 cuts. Now you're only pricing in 1. That makes me pretty bullish. But I do think the upside on the NASDAQ and the S&P is kind of limited. So I could imagine a scenario where the Fed is bullish, which is dovish, saying they're going to cut rates, but big tech doesn't benefit, right? Big tech stocks don't really go higher on that. I could envision a scenario where the Russell outperforms. The Russell could be up 5, 6, 7% in a day, depending if the Fed is super bullish or not. And I can imagine a scenario where the NASDAQ's up less than 1%, right? That would be a really good scenario if small caps were up that much in a single day. That's obviously not the base case, but I can imagine a scenario something like that, because big tech stocks, they may actually lose if the Fed starts to cut rates, because big tech has so much money on their balance sheets. They're collecting so much in interest on their cash. And when the Fed cuts rates, it really doesn't do anything for demand for products at those big tech stocks, right? So I can imagine that scenario. And I do think if there is broader upside, it's probably going to come from the Russell, small cap, interest rate sensitive, your average Joe Schmo stock, if you will, rather than just your big tech. As you have seen, big tech has been the driver of this market. The percent of stocks above their 50-day moving average, it peaked December 29th, December 28th of 2023, and it's been falling pretty much ever since. But if you look at the S&P and the NASDAQ, you did not peak in December of 2023. That's when things were just getting started for the S&P and the NASDAQ. That was right here. Whereas the average stock rallied the most from, beginning of November through late December. And this was really all big tech and AI driven. The average stock really hasn't done much in 2024. So I think it could be time for the average stock to start doing a little bit better. Tom Lee, as someone we like to reference here on this channel quite a bit, he believes small caps could still rally about 50% this year. And honestly, I clearly don't know what's going to happen. With Tom Lee's track record, I would not bet against a 50% rally. But if a rally like that is going to start, I think it needs to start relatively soon. Again, who knows? There's a lot of underinvestment into small cap, interest rate sensitive. Maybe that does change. Maybe it's time to allocate some of the portfolio back to those kind of names. So let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.